always try to pair bulls and bears, but I think on a target basis, you guys do have some differing opinions.
Yep.
You've been cautious for a while. Is the current mode we're in how you expected us to play out that cautiousness?
I came into the year actually bullish on risk assets, but after the first quarter and the great returns, it made sense to start to take some of that risk off the table. I still believe that's the case. So really you have to look at risk capital, and unless you have a really long-term horizon, as something that has to sit within a bell curve. So if your return expectations are in that bell curve, that's fine, but once they get outside there, you're supposed to take your risk down. So we've been taking risk off the table because of that.
Binky, not so with you.
Yeah.
Right?
So I would say I'm tactically negative. I'm hesitant to say sort of bearish because I remain, very, very constructive further out. Yes, I have a target of 3250 for the S&P 500 for year end, but I would argue that we sort of began to have this pullback that we were calling for. S&P 500 typically pulls back 3 to 5% every 2 to 3 months. And we're kind of sitting at that 3% mark. And I would argue, U.S. growth is going to slow, and it's going to slow further. I mean, if you look at the manufacturing ISM in the U.S., we've gone from 61 to 53. If you look at the export orders in there, they tend to lead the ISM. They're pointing to 49 over the next 3 months. So I would argue the growth slowdown is coming. I would say 1 point in the PMI is worth 2% in the S&P, so we've got another 5% to go. So I'm very much of the view that things need to get worse for them to get better. But I do believe they will.
You think that can all happen by year end? Or do you see...
I would say the sell down, the next phase of the sell down happens over the next 3 months, basically. And then we come back. Yeah.
You're thinking coming back strong. I mean, we're 400, your target's 400 S&P points from where we are right now. Percentage-wise, that's a pretty significant gain.
Yeah, so, equity markets tend to pull back. The way I look at it is, the peak last year in September was 2930. 3250 is about 10% from there. So a lot of it is just covering up lost ground from the negative rather than a new push up. Yeah?
I mean, if you look at the sectors or the industries by breakdown of who's in correction, down 10% from the highs, a lot of cyclical groups there. Energy, materials, industrials, airlines, the transports, household durables. What does that tell you?
So it tells you that the market doesn't believe what I'm saying, and of course, you want to believe what I'm saying, and therefore that's the sectors that you need to buy.
Do you think, is it going to be about, if you were to believe Binky's thesis, that it's about a second half rebound, or that the Fed comes to the rescue, or that trade reaccelerates? What?
I think everyone is relying on the Fed as kind of, in their corner at this point in time, and will make sure that the markets are okay. But if we look at real demand that's out there, the demand is from buybacks. Right? You look at, that's 85–90% of the demand right now is coming from the buyback sector. So all of a sudden, as we look at the political climate and what's going to happen over the next year or so, I think the Democratic Party starts to really get a hold of that and try to figure out ways to either curtail it or stop that from actually happening. So I think there could be some damage to the marketplace just from a political standpoint. And again, demand drivers are the key. Right now, corporations are buying back their stock, so that's an underlying base to the market. But they can't continue at this pace forever.
Powell seems to be a bit concerned about businesses also increasing their debt levels. Mentioning, of course, there are strong fundamentals, but unless they're supported by it, that could increase vulnerabilities appreciably in terms of the sharp increase in debt. You agree?
Well, absolutely, because they're using cheap debt to turn around and use that cash to buy back stock, right? So it makes sense inherently if your one job is to drive your stock price higher, but in the long run, you're trying to drive your business higher, right? So I think we have a little bit of a disconnect going on in the marketplace because it's really about long-term growth prospects of your company versus short-term where your stock is going to be. And right now, your stock is going higher based on you buying back stock.
Surely you can push back against that.
The fungibility of buyback dollars. And
I would push back very hard against that. I would say, there are aggregate or top-down sort of macro measures for looking at leverage. And sure, the traditional one, non-financial corporate leverage to GDP looks high. But I would say, it's the problem is in the denominator. GDP is just outdated for looking at U.S. corporate debt. In 1960, 3% of S&P 500 sales came from the rest of the world. Now it's 35 or 40. Cash cash levels are much higher. You take out the cash that the S&P 500 holds, and you divide by corporate profits in the national income accounts themselves, and corporate leverage looks very, very low. But macro measures notwithstanding, corporate leverage is a micro issue. If you look at the leverage of the most highly leveraged companies in the S&P 500, it's sort of stable to down over the last 2 to 3 years. Many of the aggregate measures of leverage are up because companies with negative leverage have now less negative leverage. That cannot be a corporate leverage problem. If you look at the most highly leveraged companies in the US, in the S&P 500, 45%, which is an all-time high, are defensive companies. The most highly leveraged companies in the S&P 500 have a beta to the S&P of 0.6. I mean, corporate leverage by itself is not an issue, and these companies are not responsible for any of basically the buybacks. The buybacks are all happening from companies that are basically not leveraged. So I'm pushing back very hard.
I would disagree with that only because it doesn't have. You don't look at the whole market when you look at credit. Right, because credit is talking about the bottom 10 or 20% of the credit stack, and all of a sudden, if there are problems there, that works its way entirely through the stack. So, unfortunately, that's the problem. We've probably given capital to people who didn't deserve it over a period of time.
But it's just today, BAML has a note about triple Bs delevering in advance of trouble, which we didn't see last time. Is that not a...
The leverage is very small in nature, and once you have, again, if we talk about 50% of investment grade credit is triple Bs. Even if 10% of the triple Bs have a problem, that kills the high yield market, right? So if you look at the top-down approach to credit, you'll have significant problems at the bottom, which then works its way back up to the top again.
I would totally agree. You don't want to look at this top-down. You want to look at it bottom-up. I would say bottom-up is even more reassuring than top-down.